Hello, this is Chuck Carnevale, and with this video I'm going to really deeply delve into and examine the growth and value relationship as it relates to what rate of return you can expect from investing in a given common stock. I believe this relationship is critically important, and the better you understand it, I believe the better investor in common stocks you can become. I'm going to primarily go through historical evidence of the principles that the rate of earnings growth coupled with reasonable valuation will determine what level of capital appreciation you can earn on a given stock. So I'm going to start off with the low growth stock SCANA here. And because I'm focused almost totally on capital appreciation, I'm going to take dividends paid and the dividend payout ratio off of this and look strictly at each company's earnings growth historically, and then how valuation has played a part in the amount of capital appreciation a given investment is capable of generating. So in the case of SCANA, I'm also going to take price off here. I want you to notice from the time frame 2003 to current, this company's earnings growth rate has averaged about 4% a year. Now, what I'm really suggesting here with this article in this video is that as an investor in SCANA, if I buy it at a sound valuation, my long-term expectation should have been about 4% a year. All right, so let's go ahead and put monthly closing prices on there. Now, when I look at price and earnings together and examine valuation at the beginning of a time frame relative to valuation at the end of a time frame, I can virtually instantly tell you approximately what the capital appreciation of this particular stock would be. So in the case of SCANA on this time frame, the stock was undervalued with a low PE ratio of 12.8. The orange fair valuation reference line here is a PE of 15. And it closed yesterday slightly above the orange line, or a PE ratio of 15.5. So we had two things happening here. We had earnings growth of about 4% a year over this time frame. But we also had PE expansion. We had the PE going from 12 or 13 up to 15 and a half. So just by looking at these numbers and understanding what the growth rate of this stock is, I can instantly know that my capital appreciation, had I bought the stock on this day and held it through yesterday's close, would be slightly in excess of 4.1%. So let's go down and look at that performance. Now keep in mind, I'm only looking at the capital appreciation. On the performance results here in FastGraphs, that is the annualized rate of return without dividend. Okay, so there's the 5.2%, which is slightly above the 4.1% growth rate, thanks to a slight undervaluation at the beginning and a very modest overvaluation or higher valuation at the end. So the company's earnings growth rate has been a major determinant here of the company's capital appreciation results over the long run, coupled with valuation at the beginning. Now next I'm going to change the time frame going through the recession, or at the beginning of the 2008 recession, where SCANA was available at a PE ratio of approximately 15.4, which is almost identical to its current PE ratio of 15.5. Now there's the obvious periods of undervaluation and overvaluation. Stock prices are always volatile, but it should be clear from this graph that SCANA's stock price inevitably went to where the company's operating results went, again, only from a capital appreciation perspective. So the 4.6% growth rate in this case, because both beginning and ending valuation are aligned, will generate a level of capital appreciation that's approximately identical to what the company's earnings growth rate was, 4.6 versus 4.7. Valuation and earnings growth will be the long-term drivers of total return. Now with my second example, and remember, I'm totally focused only on capital appreciation here, no dividend return. This isn't a total return exercise, it's a capital appreciation exercise, or one component of total return. I want you to look at faster growing Ross Stores. Here we see the company's earnings growth rate was 17.1%. Here we see the stock in the beginning was reasonably valued at almost the fair valuation reference PE of 16.9, and it's currently trading at an 18.3 PE. But I also want you to notice that stock price clearly tracked earnings growth over this time frame. So when we go and examine what level of capital appreciation this company achieved, it's going to be reasonably consistent with the company's earnings growth rate. Capital appreciation over this time frame on Ross Stores would have been 17.8%, which is very consistent with the company's earnings growth rate plus a little modest premium valuation at the end. With my next example, I'm going to take a look at Starbucks, and there are a couple of little ringers here that I want to interject into this discussion. The first thing I see by looking at the blue line on Starbucks is the orange valuation line isn't as meaningful in this company as we saw with both Scana and Ross Stores. Here, the normal blue PE ratio line is more relevant because this company, clearly the market has a penchant for pricing that's at a high valuation, but that does not negate the earnings and valuation relationship, because here we have earnings growth of 16.7%. I want you to notice that the stock is above the blue line, or it's overvalued at the beginning here, and it's now slightly undervalued. So we had a beginning PE ratio of 50, which is very high, and we now have a PE ratio of 27. So the 16.7% earnings growth rate in this case amounted to a capital appreciation level of 11.5%. Now I want to make a couple of comments here. The company grew at 17% a year, but you overpaid for it here, and therefore you did not get the full measure of the company's earnings growth because the valuation was high and the ending valuation was moderately lower than historical norms. But I also want to point something else out here that I think is also critically important. The relationship of growth and value still holds true, even though it does it at a slightly level evaluation. Now let me move on to a couple of other time frames here. Let me drop this down to an 11-year time frame. And here we see earnings growth of 20.3%. We still see a normal PE in the mid-20s, very similar to what we saw in the previous graph. We now have the stock undervalued. You could have bought it in October 31st of 2008 at a PE ratio of 18. Now the PE ratio is 27. The growth rate was 20%. So just by looking at this graph, I know that my capital appreciation is going to be greater than 20% per annum because I started out with undervaluation relative to the blue line and ended up with valuation in alignment with the blue line. So that's giving me some leverage, PE expansion, if you will. So now I see the capital appreciation component was 25.6%. The company only grew at 20%, but I picked up an extra 5% annualized because of valuation. Valuation and earnings growth are the drivers. With my next example, I'm going to look at Facebook, and a couple of things are really astonishing here. Earnings growth is 34.7%. The stock was originally bought at a 44 PE, currently trades at a 33 PE. So obviously, just by looking at this graph, I'm going to assume that my capital appreciation component is going to be modestly less than 34.3%. Now here I get a surprise. It's 39.9. It's in line with the 34.7. But let me explain to you why that happened, because it doesn't negate the earnings and price relationship. I want you to notice that the company had some really incredible growth years in this period of time. But nevertheless, we still have a very high correlation between value and growth. High growth, moderately reasonable valuations lead to very strong rates of return. With my next example, I'm going to look at fast-growing LKQ Corporation. Notice the consistency of the growth, earnings growth rate of 22.3%. Now what's interesting here, although it gets hard to see when the scale gets so little, the beginning PE ratio here was about 18.3. The current ending PE ratio is 18.9. So our valuations are in alignment here. So we have a 22% growth rate, and therefore it should be no surprise that our capital appreciation of 23% was directly correlated to or almost perfectly in line with this company's earnings growth. Now next, I'm going to move on to the 12-year button here, or from 2008 to current, and looking at LKQ. Now I have a different time frame. My growth rate here is still very strong at 19%, but I clearly see that I have overvaluation here, beginning PE of 30-something and an ending P of 18.9, but I do have 19% growth rate. So I know that my capital appreciation is going to be below 19% simply because beginning valuation was high, but yet I still have this correlation, this driving force of earnings growth. My rate of return over this time frame would have been 13.1%, which is less than the company's earnings growth rate. And there's another sideline here. for fast-growing companies, you probably can't overpay for them and lose money in the long run. You could have bought it here at the peak, for example, in April of 2008 and held it through yesterday's close, and you would have still generated a 13% annualized rate of return. So, valuation is going to have an impact and plays a role, but ultimately it's the combination of value plus earnings growth that drives. Now, I chose my next example, Medtronic, to try to put a real highlight on how important valuation actually is. If you go back to 2004, 5, and 6, these were periods of time where Medtronic had a couple of interesting attributes. It was growing at double-digit rates, 16%, 14, and 19. But the stock was trading at an excessively high valuation. And even though the earnings growth was strong during this period of time, I want you to notice that the stock price was literally flat. It was $51 a share in July of 2003, and it was $50 a share by May of 2008. Even into August of 2008, only $54 a share. So there was virtually no capital appreciation here. The stock then got undervalued coming into the recession, and it ended overvalued. So here you have a case of paying way too much for the stock in the beginning, and even though it's overvalued today, the PE ratio is only about half what it was during that period. And so your rate of return from this 8.8% growth rate turns out to be a rather anemic, your capital appreciation of only 4.2%. Valuation coupled with earnings growth at the beginning and the end, valuation and earnings growth, those things are all going to be the factors that drive rates of return over the long. My next example, I'm going to look at Omnicom Group, and I want you to see a couple of very interesting facts here. The company grew earnings at 9.8% since 1998. However, there were some real high periods of overvaluation here, but let's start with the beginning like we have with each other example. We have a PE ratio of about 26.5. The ending PE is 16.1. We've got 9.8% growth rate. So the company actually achieved pretty good results and actually went through the recession pretty well, staying highly profitable even though they had a down year, but they still averaged 9.8% growth. But your capital appreciation was only 7%, or not the full measure of what the company offered because the stock was dramatically overvalued at the beginning. If I shorten the time frame from 2002 to current, this was an extremely high period of overvaluation. We still have approximately the similar growth rate, 8.5% versus 8.8. But now you'll see that what the impact this high valuation had relative to the return the company generated historically. Your capital appreciation was only 3.8%. or actually less than half of what the company did as an operating business. And then finally, let's take one more look. Let's drop this down to the 10-year, where we have this 8.8% growth again. We have reasonable or pretty close to fair value at the beginning. You have the 8.8% growth, a little bit of modest overvaluation at the end. So our 8.8% growth rate translates into a capital appreciation of 9.8%, which is simply made up of fair valuation coupled with the growth rate ending up in slight overvaluation. So what I've attempted to do thus far is simply illustrate the impact that valuation and earnings growth has on the capital appreciation component of investing in common stock. Now, I do want to add that up to now, I've simply looked at history because history has actually happened. Those growth rates were achieved by those various companies I showed here in this video, and the corresponding results clearly tie in to the company's operating performance relative to the valuation at whatever time frame was being measured. But I do want to end this video by taking a look at the future a little bit. So I'm going to go down to Omnicom, and I'm going to go to the forecasting calculators, and instead of using analyst estimates, I'm going to do something a little differently here, because this video and this whole article is all about investing with your eyes wide open and having realistic expectations. Get real with what your stocks can achieve. So I'm going to use this drop down here in the historical compounded annual growth rate calculator, and I'm going to look at the historical earnings growth of Omnicom. And what I want you to see here is that this company has been a pretty consistent grower historically. Their 19-year record was the highest at 10%, but then they had periods where growth was in the 9, 8, 7, 5, and it's moving back into the 7 and 8%. So I'm going to pick kind of a middle number here, or let's use the 8.8 actually, that we talked about several times in historical graphs. And I'm going to draw this now with an 8.8% growth rate. And this is forecasting now. And what I'm really suggesting here, if I was investing in Omnicom today, I would be expecting to generate something slightly above 8% as a long-term rate of return going forward. Now, I didn't talk at all about dividends in this video. On a total return, I'd also get some dividends, so my total return could be about 10%, but my capital appreciation would be somewhere in the neighborhood of 8.5 to 8.8%. So when you buy a stock, you should be looking at it in that regards. If I go back to my SCANA example, which I opened with, which is a very low growth company, you know, it's a utility stock. Utility stocks are historically low growers. And I use that same historical compound annual growth graph, and I review their historical growth rates, you know, 4%, 4.5%. I'm going to be aggressive and use 4.7 here because that company has grown a little faster more recently. I have an expectation now of about a 4.7% capital appreciation going forward because valuation is pretty close to being in alignment, but I'm also going to pick up a lot of dividends. So my total return is going to be 7.5%. And it's going to be a mixture almost equally of capital appreciation plus dividend income that is growing ever so slightly going forward. And then finally, I'm going to close by looking at Facebook. We saw the wonderful growth that the company's had historically. So when I go through here and look and use that same notion, their historical growth rate, I'm going to pick their lowest historical growth rate here of 40.6%. And this would imply if Facebook continues to grow, the future rates of return are going to be substantial, just like they have been historically. Now, just to be fair with this particular company, I'm going to go to the 3 to 5 year trend line growth. There are 12 analysts that believe Facebook is going to grow by about 29% a year. So if I bought the stock today, I would see moderate overvaluation relative to that growth rate. I think a PE of 29 would be fair. It's currently trading at a blended PE of 34.1. That's modest overvaluation, but if this compounding effect takes hold, I could very easily make 20% plus rates of return going forward for the next 3 to 5 years. Of course, assuming that growth rate happens. But if I was investing in Facebook, that's what I'd be looking for from capital gain potential. If I was investing in SCANA, I'd be looking at 4 or 5%. And you could apply that same logic. Omnicom, I'd be looking at 8 or 9%. I always think it's critical to put valuation into perspective relative to the company's earnings growth rate and use that information to determine what a realistic expectation of what a stock can do for you over time. This has been Chuck Carnevale saying thanks for watching. I hope you got a lot out of this and recognize now the importance of value plus earnings growth in determining the capital appreciation component of total return. Thanks again.